Diversification is for the know-nothing investor. It's not for the professional.
If you find 3 wonderful businesses in your life, you'll get very rich.
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Know the edge of your own ability pretty well. The Munger family's in 2 or 3 things only. Diversification is my idea of something I have practically no interest in. A lot of people who are geniuses on IQ tests think they're a lot smarter than they are, and what they are is dangerous. We're not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. One of the inane things that's taught in modern university education is that a vast diversification is absolutely mandatory in investing in common stocks. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But that's, there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. And we've had the chance to do that way in our past when we were working with small sums of money. We'll never get a chance to do that working with the kinds of money that Berkshire does. We try to load up on things, and there will be markets when we get a chance to from time to time, but very seldom do we get to buy as much of any good idea as we would like to. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50.
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult. And it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah. Yeah, and the high priest wouldn't have any edge over the lay people, and that never sells well.
Right.
Basically, the Munger family's in 2 or 3 things only. Diversification is my idea of something I have practically no interest in, except as it happens automatically in a big place like Berkshire. I rejoiced the day I got rid of a quote, a stock quoting machine. I like this buy and hold investing. It's a lovely way to live a life, and you deal with a better class of people. And it's worked pretty well for all of us. So, and I don't think you need to worry about Warren's side investments. His investments through Berkshire are so huge, and those are so small relatively that if that's your main problem in life, you have a very favored life.
When I got out of school in 1951, the 2 people I admired the most in the world, my dad and Ben Graham, both said, you've got a good future, but don't start in stocks now, because there's never been a year when the Dow Jones average has not ended up below 200, and it's above 200 now. It's much too high, and if you start now selling stocks to people, they're going to have bad experiences. And so why don't you go wait a while and go work in the Omaha National Bank or do something, park yourself on the sidelines. There's always negatives. The country always faces problems. I mean, this country went through, it went through a civil war. It's gone through all kinds of things. But what happens? We have a few lousy years from time to time. I mean, we've had probably 15 recessions since the country started. And we will always have a list of 10 or 15 things at the start of the year that will tell you why, this country can't possibly work well. But all I can tell you is that it doesn't do it in a straight line. But the power of capitalism is incredible. I mean, that's what is bringing us out of this recession. I mean, monetary and fiscal policy have some utility, and certainly in the fall of 2008, the government was needed in a huge, huge way. It could do what it was the only one that could do what was needed. But if you look at the history of the United States, probably half of our recessions have occurred during, we'll say in the 19th century, when people didn't even know what fiscal or monetary policy was. I mean, what happened was that excesses would come in, and then the resuscitative power of capitalism would set the country back on the right, on a stronger growth pattern. And that's happened time after time after time. And the game isn't over. What has happened is the rest of the world has caught on to some extent. So you're seeing, some state capitalism in places like China, and they're turning economies loose that have been dormant for centuries. But it's not because the people are smarter. It's not because they work harder. It's just because they have tapped into a system that works marvelously over time. And I will tell you, in the next 100 years, you're going to have probably 15, maybe as many as 20 lousy years, but we will be so far ahead of where we are now that will be unrecognizable. Charlie?
Well, I think you can go back a lot farther than that. Europe survived the Black Death, where about a third of the people died. The world is going to go on.
That's wildly optimistic for Charlie. Have you got anything more encouraging than that to say, Charlie?
Well, I don't know. I understand a little bit of Dick Holland's point of view. And by the way, I've known him a long time. He aced me out of any hope of being the chief candle snuffer at the Unitarian Church. He was so damn good at it. Anyway, what was the question?
Can you bring yourself to say anything optimistic?
Well, I have a little bit of a twist on that. And so I would say that you can be cheerful even if things are slightly deteriorating. And that's a very good quality to have. I have a personal saying that has always amused me. I say the politicians are never so bad you don't live to want them back.
Apple is not 35% of Berkshire's portfolio. Berkshire's portfolio includes the railroad, the energy business, Garanimals, you name it, See's Candy. They're all businesses. And, the good thing about Apple is that we can go up. They buy in their stock, and instead of owning 5.6%, they got about 15 billion, 700 and some million shares outstanding. They get down to 15.25 billion without us doing anything. We got 6%. So we can't own more than 100% of the BNSF. We can't own more than 100% of Garanimals or See's Candy. And it'd be nice. We'd love to own 200%, but that just isn't doable. But they're all the same. They're good businesses. And to think that our criteria for Apple is different than the other businesses we own. It just happens to be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own 100% of, but we're very, very, very happy to have 5.6 or whatever it may be percent, and we're delighted every 1/10 of a percent that goes up. That's like adding $100 million to our earnings. I mean, our share of the earnings, and they use the earnings to buy out our partners, which we're glad to see them sell out too. The index funds have to sell out. They bring the number of shares down. And, we went up slightly last year, and
I made a mistake a couple of years ago when I sold some shares when I had certain reasons why gains were useful to take that year from a tax standpoint. But having heard me say that, it was a dumb decision. But we do not have 35% of Berkshire's portfolio. Berkshire's portfolio is the funds we have to work with. And we want to own good businesses, and we also want to have plenty of liquidity. And beyond that, the sky's the limit, or our mistakes, who knows what the bottom is.
It's not that easy to have a vast plethora of good opportunities that are easily identified. And if you've only got 3, I'd rather be in my best ideas instead of my worst. And now, some people can't tell their best ideas from their worst, and in the act of deciding that an investment already is good, they get to thinking it's better than it is. I think we make fewer mistakes like that than other people, and that is a blessing to us. We're not so smart, but we kind of know where the edge of our smartness is. That is a very important part of practical intelligence. And a lot of people who are geniuses on IQ tests think they're a lot smarter than they are, and what they are is dangerous. But if you know the edge of your own ability pretty well, you should ignore most of the notions of our experts about what I call diversification of portfolios.